let me ask you a couple of questions about the different things that we covered yesterday before we get into new financing stuff. Because financing, just like many of the other chapters, is going to be all about repetition, right? Hearing it as many times as you possibly can to try to store the information to the best of your ability so that you can retain it and use it on the test. So, if I was to talk about a budget loan, what am I talking about? What makes something a budget loan? Got a couple things in the chat saying pity. There you go. Accounts for taxes and insurance. There you go. Folks, we're going to talk about it a little bit more today, but there are some loans that do not include the taxes and insurance, and there are even some loans where you're making principal only payments. And so we're going to get into those. But yeah, the budget loan is where you are comprised of that, your monthly payments comprised of that pity component, right? Principal, interest, taxes, and insurance. So the principal and interest goes to the bank to pay off what you borrowed, plus interest, obviously, and then the taxes and insurance go into an escrow account where they hold money on behalf of you to pay your tax bill and your insurance bill. What was the other name for that P&I portion of that payment? What do we call that when we're just paying principal and interest?
Debt service.
Debt service it is. And so we talked about some of the amortization math and the different ways that that works. Brooks, just out of curiosity, because I still see you struggling with it, and hopefully you can hear me. Do you have a privacy shutter on your computer? Because it's acting like that's closed, which means it's not registering your camera. I mean, it's just a guess because, you know, sometimes that pops up when people have their privacy shutters closed on their computers and they try to turn their cameras on. It'll say nope because privacy shutter's closed, but that may not be the case. I just thought I'd ask. And keep playing with it. So pity payment, budget loan, debt service, all that fun-filled jazz. What about the two different types of finance theory? What were the two different types of states in regard to finance theory? What do we call those? There you go. Title theory and lien theory. And which one is North Carolina? There you go. Title theory, you bunch of mutes, just typing away on the keyboard. Title theory is what North Carolina is, which means that we utilize what type of security instrument in North Carolina? There you go. Deed of trust, that is that specific lien that gets attached to the property. And how many parties are involved in the deed of trust instrument? 3. Good. And who are they? The grantor, the beneficiary, and the trustee. And what is the other name for the grantor? There you go, the borrower. What is the other name for the beneficiary? Yeah, the bank. Beautiful. Love it. Y'all are on it. Okay. There's no other name for the trustee that you really need to worry about. How about the lien theory states, which North Carolina is not? Lien theory states utilize what type of security instrument? Or what type of lien? You could call it either. A mortgage. There you go, a mortgage. And so how many parties are there in the mortgage instrument? There you go. Cheyenne says 2. And who are they? The mortgagor and the mortgagee. And who is the mortgagor? There you go. The mortgagor is the borrower, right? The mortgagor is the borrower. The buyer is the mortgagor. And remember, the way you remember that, the mortgagee is never me. Because the bank gives you money, a loan, and you give them the mortgage, which pledges the home as collateral, and you give them the promissory note, which is the evidence of the debt and the promise to pay it back. So the borrower is the mortgagor. And of course, the bank is the mortgagee. And so going back to the foreclosures, what type of foreclosure does a lien theory state utilize? Judicial foreclosure. And what type of foreclosure does a title theory state utilize? Power of sale. There you go. Beautimous. Y'all did excellent on that. Thank you. Other things that we got into, folks, obviously, we talked about discount points and loan origination fees. Those are math. Those are buyer debits. As you can see, we talked about loan to value ratios. And then, of course, we got into different loan types, and that's where we left off. And we're going to pick back up. So we talked about conventional loans. What was the biggest thing that is true of a conventional loan? What do we call them? Or what type of loan? You can't say no assumptions. That's not a factual statement. A lot of times they're not assumable, but we can't say never. Yeah, let's go with what Bridge said. Non-government backed. The conventional loan, not what's on the screen, not anything else. I'm just recapping with you. The conventional loan is not backed by any government. And so what was the other word for not backed by any government? Private. There you go. Private, which means the bank bears all the risks. And so, of course, there are varying down payment options or loan to value ratio options for conventional loans. The most common is a certain number, but let me not give away that number. What down payment would the bank like to see to not require you to have private mortgage insurance? 20%. There you go. 20% down payment in order to not have any private mortgage insurance. Anything less than that, you're considered a higher risk, and they would require you to have that private mortgage insurance. So conventional loans, completely private, no government backing, all based on these loan to value ratios, things of that nature. Then we got into the FHA insured, and the insurance is provided by the Federal Housing Administration, and that's why it's just called mortgage insurance, not private mortgage insurance. And so the FHA has down payments of 3.5% down, so very high loan to value ratios. That insurance policy is not covering the full balance of the house. It's basically covering the spread between the amount that you put down, 3.5%, and the 20% that the bank would have liked to have seen if it was a non-government backed loan. And so that's what that insurance covers. Of course, the other things we said, because the FHA loan is a government-backed loan, it is not allowed to have what two clauses because it is a government-backed loan? Yeah, no prepayment penalty clause and no alienation clause. There you go. Also called the due on sale clause. Those are prohibited in government-backed loans, which means FHA loans and VA loans are always assumable, and there is never a penalty for prepaying them off early. So we left off talking about VA loans, and remember, VA loans are for veterans. VA stands for the Department of Veteran Affairs, and so active duty, retired, honorably discharged, spouses of military, you only can get a VA loan if you are some type of military that has what's called a certificate of eligibility and entitlement given to you by the Department of Veteran Affairs. Now, the difference is there is no insurance premiums on here. It's not technically insured because you're not buying an insurance policy. The VA is acting as your insurance policy, and because you're not making payments, they just call it a VA guaranteed loan. They're the ones that basically state, we will cut the check for the disparity of the zero down payment that you got and how much the banks would have liked to have seen in the instance of a default. Now, there is no maximum loan amount, and there is no technical maximum guarantee amount. You would have to reach out to the Department of Veteran Affairs to figure out, what your entitlement is. 100% loan to value ratio, which means very, very high loan to value ratio because you don't have to put a down payment. It is for owner-occupied loans. Several other things that we talked about yesterday is The VA does not typically lend the money. However, we said in very specific circumstances, they may in certain areas for certain qualified borrowers. And then just like FHA loans, they have very specific standards of construction, right? They have to meet certain criteria. Otherwise, they're not going to be funded. Now, here's another interesting piece. I told you all government-backed loans, thus far we've talked about the FHA, now the VA, are always assumable. So a VA loan is assumable even by somebody who is not a veteran. And so the danger of that is, though, if you allow a non-veteran to assume a VA loan, the veteran's entitlement is still tied up in there, which means that the person who assumes it was to default, the veteran could lose their entitlement permanently. So it is not advisable to let a non-VA borrower assume a VA loan because it could destroy the entitlement of the veteran. Couple other things here, as we said, no prepayment penalties. And of course, anytime you pay off your loan, you would restore your entitlement, and you could use these forever and ever and ever. If you had enough entitlement and you made enough money, you could arguably purchase two homes simultaneously, or not simultaneously, but have two homes simultaneously. Because this is designed for owner occupied, you would have to buy the home with the intention of living in it. But after certain time periods were met, they would allow you to turn it into a rental. It's typically like a year or two, depending on if you've been moved or relocated for, the military or anything like that. And then let me tell you the other thing about this that gets kind of squirrely on the test. And this is where there's a little bit of a difference between the real world and the textbook. And I've seen it both correctly and incorrectly on both. Don't worry too much about which one's right and which one's wrong. Let me tell you what to look out for on the test. What you basically have to understand is that you actually can roll in some things above and beyond the purchase price of the house into the loan. And so here's where the discrepancy lies. Some will tell you that you can roll in some closing costs, but not the VA funding fee. Some will tell you that you can roll in the VA funding fee, but not closing costs. At the end of the day, it should be most testable as you can roll in the VA funding fee to your loan. And in other words, your loan to value ratio could actually exceed 100%. That's the other really testable piece of this. Because if you're buying a $400,000 house and they allow you to roll in, a $2,000 funding fee, then you really are borrowing $402,000. So your loan to value ratio is actually even a little bit higher than 100%. That's really the big takeaway. Don't worry so much about whether it's the closing cost of the VA funding fee. I've seen the textbooks and the real world contradict themselves. Just know that you can roll in some cost to it. That's basically what you need to know. As I said, in the real world, these are kind of complex. And from a textbook point of view, there's just certain key pieces. One last note here on VA loans. Remember, the lenders are the ones typically lending the money. The lenders are the ones that are setting the interest rate. Sometimes there are points, and the interest rates are typically slightly lower than even conventional rates. So these are, like I said, great loans for veteran buyers, for people who qualify for them. Another thing to be aware of in both these government-backed loans, we talked in the contract section in North Carolina, right? The North Carolina contracts and the standard forms and stuff. We had that thing called the FHA VA financing addendum. And why that form was important is because there are certain protections in place because of these two government-backed loans, and that comes down to an appraisal. Because the government has some skin in the game, they want to make sure that these properties are worth what you're paying for them. And so let me just start with the VA loan first, and then I'll kind of duplicate it because it kind of works the same. On that VA FHA financing addendum, it states that the VA is going to order an appraisal to determine what they call the CRV, right? The Certificate of Reasonable Value, what the VA thinks it's worth based on their appraisal. And they will only loan you 100% of that. And so if it doesn't appraise for the purchase price that you want to buy it for, you could still potentially buy it, but you'd be bringing the other funds out of pocket because they're only going to give you 100% of the appraised value. What it also states is if it doesn't appraise, you could elect to not buy the house without forfeiting your earnest money. But it doesn't protect due diligence, just earnest money. So you can still buy it if it doesn't appraise, but you would have to bring the funds out of pocket for any difference there. Because remember how these loan to value ratios work. They're going to give you that percentage of the purchase price or appraised value, whichever is lower. And the same thing is true of the FHA loan. On the FHA VA financing addendum, North Carolina, it says the same thing. If the FHA appraisal doesn't come back for the purchase price, buyer could elect to not buy it and not lose their earnest money, but it does not protect due diligence money. Let's say you gotta be a little more specific. The FHA VA financing addendum, is that what you're talking about? Yeah. Yeah, that was a specific addenda that we had in North Carolina that we would attach if we were purchasing a home with an VA loan or a FHA loan. Oh, what you got, Beverly?
Just really quick, I only know VA financing. So with conventional mortgages, the banks require an appraisal too, right?
Yeah, it's both. It's the appraisal for the bank, but it's a VA certified appraiser, just like the FHA certified appraiser. There's certain appraisers that can do VA loans.
Yeah, I mean, I know that, but like on a conventional loan, it's the same. It's a similar-ish process, meaning the bank won't loan you the money without the house appraising.
Yeah, no, it's exactly the same. But there's no protections in place for a conventional buyer. It's only because of the nature of like government having skin in the game that this document exists. It says you can get out without losing your earnest money.
Gotcha.
Yeah, that additional protection. That's right.
Okay.
Yeah. Brooks, did you see my message? Try hitting F8. What you got, Sinful?
But only the difference between the VA loan and the conventional loan, both we need appraisal. But VA loan, the appraisal required for the VA certified appraiser, correct?
Yeah, you have to be different appraiser. You have to be certified to do FHA and VA appraisals. It's not just any old appraiser.
Okay.
Yep, but they all require appraisals if you're getting a loan from the bank. The bank's always going to require one.
Might be in the questions, the real time the question they can twist, right? Maybe the VA loan, VA certified only, those people only, those appraisers only valid for sorry, I don't know how I'm articulating correct or not.
Well, yeah, I mean, yeah. If you're asking if that could be kind of like a testable question, yeah. I mean, they could. You know, which of the following would be true in regard to FHA or VA appraisals or things like that? They would have to have a certified appraiser. That could be something that would show up on the test. Yep. Mm-hmm. I do want to go back real quick just to clarify one other thing. Folks, I told you VA loans are assumable by anybody, not just veterans. And so even a non-veteran could assume a VA loan, but I told you that there is, of course, a risk there because when somebody assumes your loan, there's going to be a release of liability on behalf of the bank where the bank says, okay, well, this person is now responsible for paying this loan and we're releasing the previous borrower, which was the veteran. But in order to get their entitlement back, they would need a secondary release from the VA of the entitlement. And they're not going to get that if the person who assumed the loan is a non-veteran, because there's nobody's entitlement to tie up. So if say, another VA buyer was borrowing or assuming that loan, then they could have a release of liability for both the lender and the Department of Veteran Affairs to prevent the previous entitlement from getting tied up. But is that going to be like a super specific test question? No. Just understand that there is a risk for a non-veteran assuming it, because it could cause the original veteran to lose their entitlement. And if this person defaults or anything like that. Now, the last government loan is one that was mentioned yesterday. It is a USDA loan, and USDA is the U.S. Department of Agriculture. The U.S. Department of Agriculture. Agriculture. And so these loans are for moderate to low income families in more rural areas. Folks, what it comes down to is, you have to understand, in more rural areas where populations are lower, that means the municipalities aren't making more money. So how do you combat that? If you make it more affordable or have better loan programs for buying houses in more rural areas, more people buying in that area means more taxpayers. More taxpayers means more income for the municipality. More income for the municipality means growth. And so it's a win-win. And so these maps are regularly redrawn. There's a lot of areas in Johnston County and Wake County and Harnett County that used to be eligible for USDA, but because they've grown so much over the past decade, they're no longer eligible for these USDA. These are very map specific. You would have to go to the U.S. Department of Agriculture's website, type in an address, and it's either yes, this qualifies for USDA, or no, it does not. It's that straightforward. Of course, the cool thing about the USDA loans is, just like the VA loans, there is 100% financing available, and these are for anybody, as long as you don't make too much money. And so these would be a fantastic starter loan because you can get in with zero down payment. So would have to pay closing costs. And of course, only qualifies for certain areas, but really, really great loan if you can get one.
Do they have reno features built into those loans too, or rehab rather?
I honestly don't know for that one. They're not been very common in recent years. It's been probably about a decade since I've seen one. I'm not going to say they don't exist, but we don't talk about them as much, so I couldn't tell you, to be honest. Yeah.
Okay.
Are they super restricted like the VA loans are?
Depends on what you mean by restricted.
So I've heard people say that they don't want to take VA loans, or not VA loans. Not that FHA loans and stuff. Certain sellers, because it's harder, or it's a lot or something.
Yeah, we kind of talked about that yesterday. The reason is, it sometimes puts an additional burden for VA, especially for the seller to make repairs in order for the deal to go through. And of course, sellers don't necessarily like that when it's compared to other loans. And so FHA, VA, and in some instances, arguably USDA could all impose a few more restrictions or burdens on the seller. But because USDA is not as common, I couldn't tell you to what extent that they're expecting things like the FHA and VA I know are. Yeah. So let me ask you a question, folks. See how you're feeling. True or false, conventional loans are insured by federal agencies such as the Fair Housing or Veterans Administration? Yeah, false. Now, folks, this is false for two reasons. Number one, conventional loans are private loans. They have no government backing or insurance. The other reason why this is false is because fair housing has nothing to do with FHA. I told you, don't get that confused. It is the Federal Housing Administration, not the Fair Housing Act, which we'll get into later. Different things. So the government-backed loans, FHA, VA, USDA, they all have some government backing, all have some additional protections because of the government, and they are required to conform to what we call HUD. HUD is the Department of Housing and Urban Development standards for, lending and government backing. We're going to get into the Fed and HUD and the CFPB here in a little bit to help you understand the secondary mortgage market and kind of the underwriting aspects a little bit more. But these all do have to meet these HUD standards because they're government-backed loans in that regard. So, word of caution for what I'm about to introduce to you folks. I've used this term before, but I haven't taught this to you yet. And you've got to be very careful because this concept very often confuses students on the test. And the concept is called a purchase money mortgage. Purchase money mortgage is a type of seller financing, folks. It is where the seller acts like the bank. I want you to think about the name, purchase money mortgage. Now, mortgage is used inappropriately in a lot of facets, and this is arguably potentially one of them, but I digress. It's where the seller is giving the buyer the money to purchase the home and taking a mortgage, just like a bank would. It is a seller acting like a bank. And so here's the key piece, folks. When this happens, the seller will actually convey legal title to the buyer at the time that the transaction closes. And then they will record a promissory note and a deed of trust or mortgage against the property, just like a bank would. The reason why students get very confused on this is because in a purchase money mortgage, the seller conveys legal title initially and takes back a promissory note and a deed of trust or mortgage. And students always have a tendency to confuse this with the installment land contract, which is where the seller retains the legal title. It would not convey it to the buyer until they made the final payment. Do you see the difference there? In a purchase money mortgage, the buyer gets legal title at closing. And then they start making payments to the seller like the seller is the bank. And these sometimes are for the full purchase amount. These are sometimes just done for down payment amounts if the other lender approves them. Are they common? No. Are they testable? Yeah. Purchase money mortgage. True seller financing. Sellers acting like the bank. They're conveying legal title to the buyer and taking back a note and a deed of trust against the property, just like a bank would. Now, because this is seller financing, we also said that in North Carolina, if the borrower defaults, the seller cannot file for a deficiency judgment because they are acting as the bank. If the buyer defaults, they would foreclose, just like the banks would. But they're not allowed to file a deficiency judgment because arguably they would just get the house back as the previous owners. It's kind of a little different in that regard because they were the owners, whereas the bank never was. Yeah. Now, folks, as you might imagine, you can't do this unless the house is paid off or is being paid off in some way, shape, or form because you're transferring title to the property, which would trigger the alienation clause on most loans if applicable. So the installment land contract could be done even if you still owed the bank. This could not because it's probably going to trigger an alienation clause because you're transferring legal title. Is this going to be heavily testable? No, but you've just got to make sure that you understand the legal title aspect on this versus the installment land contract. Do not get them confused. I told you, think of the installment land contract more of a rent to own scenario. And this is, you've been given legal title, but they took a lien and a deed of trust against the property, just like the banks would. The seller did.
Can you repeat that last comment that you made? You said a title or a land installment can do this, but...
Yeah. An installment land contract could be put in place even if the seller still owed the bank money because they're not transferring legal title yet. This could not because most of the times when you still owe the bank money, The current promissory note has an alienation clause in it, and since you're transferring legal title, that would trigger the alienation clause, and so you couldn't do this if you still owed the bank. Now here's where we're going to switch gears a little bit and kind of talk about not so much the loan types, but repayment structures, folks. And I'm going to bring back something I said very early on in this class. Do you remember when I started talking about freehold estates? And we talked about, fee simple to feasible and, qualified fee. And then we got into, concurrent ownership. And I said that was a hard concept. And a lot of you threw up in your mouth in that section too. But what I told you was, just because it doesn't make sense to you doesn't mean it doesn't make sense. And that's going to hold true in this section too. So for most people, when they're borrowing money, they are doing what is called, and I've told you this term yesterday, a fully amortized fixed rate loan. When we're dealing with a fully amortized fixed rate loan, that means your interest rate is fixed. It's not changing for the life of the loan unless you refinance it or do something. And fully amortized, remember, amortized is just a fancy word for paying off your loan. So fully amortized means it is structured to where you make the last payment and your balance is zero. And that's what most people are doing when they buy a house. They're getting a 30-year fixed rate, fully amortized loan, which means if you make your minimum payment every single month for 360 months, when you make that 360th payment, your house is paid off. That's what that means. Fully amortized fixed rate. Now, there is two other options, folks. There is what we would call, and it's not on this slide, but it shows up later, a partially amortized loan. A partially amortized loan would be payment structures where you are paying down your principal balance, but at the end of the loan, there's a lump sum left to pay. That lump sum is called a balloon payment. So, for example, you could get a loan. Let's say you borrow $400,000 and you finance it over 10 years, and you've made payments every month over 10 years, and it's structured to where at the end of 10 years, your new balance is $200,000. And so in a partially amortized loan, when your loan is up, you would make a balloon payment to pay off that remaining balance. Doesn't make sense to most of us because most of us are not anticipating having $200,000 to pay off our house in a lump sum, which is why we do fully amortized. But it does make sense for some people, and it does make sense for some loan types. So then the other option is what we call an interest only, and it is sometimes called just a term or straight loan. And so in other words, folks, you borrow money from the bank, and you are making only enough of a monthly payment to cover the interest, which means your principal balance doesn't go down. So for example, the most common time that this is utilized is for developers. If a developer purchased a piece of land for $1 million and they were doing a term or interest only loan and it took them 3 years to develop it, they're making monthly payments every single month to the bank over this 3 years. But at the end of 3 years, their balance is still $1 million because all they've been paying the bank is their interest. They have not been paying enough to pay down the principal balance. And so what they're going to do is they're also going to make a balloon payment at the end, a lump sum. They're going to pay off $1 million. Well, folks, how are they going to do that? They purchased this for $1 million. It cost them $2 million to develop it, but then they turn around and they sell all the lots for $6 million. And so now when they sell off all the lots, they can pay off their initial principal balance of $1 million. They can pay off the other borrowed $2 million for developing it, cutting in the roads, paying their subcontractors, and they're left with $3 million in profit. Does that make sense? It doesn't make sense for you because none of us anticipate having $6 million at the end of our loan term. But a developer who is developing it for a profit is going to be able to do it. So that is called an interest only, also sometimes referred to as a term or straight loan. The other one I talked about where you were paying down some of the balance is called a partial amortization. But most of us do the fully amortized fixed rate loan. Oh, Brooks, it looks like you got it fixed. What was wrong with it?
I have no clue.
No idea?
No, it said check your camera, so I ran my thumb over it and it popped on. I was like, all right.
Oh, you mean the privacy cover was closed?
I didn't even know there was one.
A lot of people don't. Yeah, that's why I was trying to help you out, because it happens all the time. Yeah, happens all the time. So, a couple other things that I'm sure you've heard before, folks. Adjustable rate mortgage. Okay, that's the opposite of the fixed rate. A fixed rate means your interest rate does not change for the life of the loan. An adjustable rate means your rate could fluctuate up or down based on the consumer price index. Basically, the consumer price index is the ebb and flow of how the economy is doing. Okay, so it could go up, could go down, typically goes up. And when you're dealing with adjustable rate mortgages, there is no one size fits all. There's 2-year ARMs, there's 3-year ARMs, there's 5/1s. So a 2-year would be, it could only fluctuate every 2 years. A 3-year could only fluctuate every 3 years. There's also 5/1 ARMs, which is fixed for 5 years, but then it would adjust every year after that. So there's no one size fits all. The reason why some people may go with an adjustable rate mortgage, but they got to be careful, is because they typically will give you what's called a teaser rate. Excuse me. In other words, a lower than average interest rate to begin with. So let's say that, you could get a fixed rate right now for 6.7. You may be able to get an adjustable rate mortgage for like a 5.2. And why are they doing that? Because they get you in at this lower teaser rate, but then as it fluctuates, they're going to get their money back as your interest rate goes up. So there could be some advantages to somebody if they're planning on refinancing in the very near future or selling in the near future because they have that lower rate to start with. The dangerous thing about adjustable rate mortgages, folks, there are two things that are sometimes present. There are sometimes payment caps and there are sometimes interest caps. If you had a cap on the interest, it would say, okay, well, your interest rate can't go above this number, which sounds great. The payment cap, however, is kind of dangerous because imagine that your interest rate climbed to something like a 9% and then your payment cap was $2,500 a month, meaning that you would never get charged more than $2,500 a month. But now that your interest rate has gone up to 9%, your $2,500 a month payment isn't even enough to pay all of your interest. And what that results in is a very, very bad thing called negative amortization. It means you are making your monthly payments, but your principal balance is going up because interest is getting tacked on and tacked on and tacked on because you're not paying enough to pay it down. And this was a very bad thing that was happening in the housing market crisis of 2008, 2009, 2007. They had programs called Pick a Payment, where you could literally tell the banks what you wanted to pay each month, and they were relying on your stupidity to not pay enough, and they were able to just keep tacking on interest. So, very bad thing. What you got, Brooks?
So when you say like payment cap, does that mean like you can't actually pay what it is, or like they won't charge you more than $2,500?
Yeah, they don't expect you to pay more than $2,500. You could always make a supplemental payment in excess of that, but they are never going to send you a bill for more than that, which is the danger of a payment cap. Because while it sounds great, it could be a very bad thing.
So would they not? Would the mortgage company not inform the
Mortgagor.
would not inform the homeowner that it's not going to be enough to cover the payment or the interest?
Well,
Or
that
they
was-
just let it fly and ignorance is bliss for them.
They'd be informed, but most people, even when informed, are ignorant and enjoy their blissful ignorance, Yeah. What you got, Parker?
So there's always a fixed payment amount on these type of
Doesn't have to be. No, there is options to have interest rate caps and payment caps, but there's not always payment caps.
Okay.
Yeah. And that's why, there is no one size fits all for these. And so you really got to read the fine print on exactly what you're getting yourself into with an adjustable rate mortgage, because it could be to your benefit if you get a good rate for 5 years and you're going to refinance in less than 5 years or whatever it may be, Yeah. But got to be careful. Cheyenne, you look dead for a second. I'm like, is Cheyenne alive? Like, you're like over there, like, I'm like, oh my God. Because like your eyes were open, but you weren't moving. I'm like, oh my God.
I laughed, so
I just didn't know if we needed to call 911 and try to figure out where you lived. Like, I'm like, oh my God, Cheyenne's out.
alive.
Okay, all right, I'm making sure. Okay, I don't need that. So let me ask you a question here before we get into some more discussions. What you got, Bridge?
Typically, at the end of the adjustable rate mortgage, if you're in negative amortization, is there some kind of balloon payment, or do they just extend the life of the loan?
Yet again, depends, right? Ideally, if you refinance, you're gonna have to pay the full balance, and so if you refinance to get out of that, and as long as there was enough equity in the house, you could probably just refinance it. There could be the potential for a balloon payment if you're trying to refinance to be able to get out of it, because it may not be worth as much as they would like to see for equity. It would just depend, but yeah, there's definitely something to consider, right? Yeah. So here's a question for you. True or false, in a purchase money mortgage, buyer receives equitable title at closing and the deed once the debt is fully satisfied. That is false. All of you are putting false in the chat. The reason why I look so perplexed is because, folks, and I'm not kidding, and I'm not just trying to like make y'all feel good. I have taught this class probably over 1,000. Like so many times. Okay, just so many times. And even the way that I just intently emphasize the difference between the purchase money mortgage and the installment land contract with you folks, I do that with every class. And I can't tell you how often classes will still tell me that this is true. And not a single one of you told me that this was, like, I'm just, every single night, I am just overly impressed with your group. Because y'all are catching the things, and I'm not teaching it any different, right? I've got this thing down where I'm just like, I say the exact same basically every time. So, y'all do impress me the way that y'all have a tendency to grasp the things that normally would trip up other students. So, kudos to y'all. So, I'm proud of you. Folks, don't get excited just because you see Unit 14. I told you financing is broken into 2 chapters. You're not done with financing. This is just the first part of financing. So just take it with a grain of salt. All right. Acceleration clause. Will you tell me, what's an acceleration clause? Pay now, you messed up. Sounds like a loan shark, Bree. That's right. Otherwise, we'll club you in the kneecaps. Yeah, there you go. Speeds it up, right? You had 30 years, but you done messed up, Aaron, and so now the full balance is payable immediately. Okay, loan origination fees. There is no set rate. It's just a fee that the bank charges to originate the loan. Deed of trust is a security instrument used in title theory states, which North Carolina is. 3 parties, right? Discount points. Prepaid interest increases the lender's yield and lowers the borrower's interest rate. Cost 1% of the loan amount, and buying 1 point decreases your interest rate only by how much? 0.1%. Some of y'all either type exceptionally fast or you're expecting these questions before I say it, right? And I don't know which one it is. Title theory state, which North Carolina is, uses that deed of trust. Hypothecation is the act of pledging. Right of redemption during a foreclosure. You can pay off the balance in full and stop the foreclosure process in all states. North Carolina, we have that 10-day upset bid period that would continue on anytime somebody submitted an upset bid. And of course, a short sale would be where you ask permission from the bank to sell property for less money than what you owe. So it's called a short sale because it is short on funds to satisfy all liens.